Okay. What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis on Dexcom stock. This is a stock that I've not bought before. I just started learning about this recently because my friend Akash pointed this out to me. And as soon as I checked the financials, I thought it was interesting because the stock is down big time. The stock has been, in the last 5 years, the stock has been over $130 at least three or four times. And now the stock is almost at a 5 year low at only 60 bucks. In the last year, a year ago, the stock was $90. Now it's only 60. And if you look at the financials are really strong. So this is a medical device company with a market cap of $23 billion, headquartered in San Diego with over 11,000 employees, founded in 1999. So if we look at this, we can see that Dexcom looks like a strong growth medical device company with a defensible moat, and the clearest upside drivers are continued CGM adoption, international expansion, the G7 15-day rollout, and the new products like Stelo. For the period I asked about, published forecast data points to rising income and cash flow through the next couple of years. If we look at their moat, it's mainly built off of switching costs, clinical trust, and proprietary biosensing tech. Patients, clinicians, and app ecosystems get embedded into the device and data workflow, which makes replacement harder than with many consumer products. It also benefits from regulatory approvals, manufacturing scale, and a growing installed base that reinforces brand credibility. Great. But like this is a with all that stuff being said, it's still a very competitive space. There's always new players coming. And I think that's always going to be a danger and a risk to investing in companies like this. The biggest growth engines are the G7 and G7 15-day adoption, which could widen the TAM, improve convenience, international expansion, especially where Dexcom is already seeing faster growth than in the United States. The Stelo product which opens a broader non-insulin and over-the-counter style market, and margin expansion from manufacturing efficiency and scale, which can lift EPS faster than revenue. That's what we like to see. The forecasts show revenue rising to $5.2 billion for this year. Keep in mind, last year revenue was 4.6. So we're looking at about 12% growth per year. If we look at the last 5 years, they grew about 19%. So the revenue growth has slowed just a little bit, but it's still solid growth. And keep in mind, the valuation is not that high. Price to sales is just it's just mediocre, but the PE is pretty cheap, and the free cash flow yield is definitely cheap. Then we come down for the future years. The revenue is still expected to rise. Net income rising from under $1 billion to almost $1.5 billion in the same years. Free cash flow, same thing, under $1 billion, and then goes up to over $1.5 billion. Dexcom also reported last quarter's GAAP net income, which is what we want, GAAP of $200 million, non-GAAP of 264, and reaffirm the revenue guidance of over $5 billion for this year, which comes at about $5.2 billion, and EPS of, what did they say, 200 million? So you got to think $200 million, which I think that's what it shows. Yeah. So net income and free cash flow both are strong here. They're both trending in the right direction. 930 million for the past 12 months and over a billion dollars, 1.4 billion for cash flow. We're only paying $23 billion for this company. That's really not that much. So that's why I was interested in this from the beginning. The forecast EPS figures in the data rise from about $2.44 this year to about 3.5 in 2 years from now. So, I mean, just think about 3.5. If you put a 20 times ratio on that, which is about where it's at now and is pretty cheap, um, 20 times 3.5 is 70. So you would see a $70 share price in 2028, which that's really not a good deal, really, if you think about it. But hopefully that PE ratio can go back up. That's kind of the idea here. If you look at the PE ratio right now, it is at around a 25. But I mean, look at the last 2 years. I mean, it normally was a much higher. It was a 40. It's been in the 60s. So it really just comes down to the growth, I think. The problem is that growth is, well, they're saying net income, the earnings growth is going to grow faster than revenue growth, which that definitely needs to happen because revenue growth is only 12%. But net income growth past couple years has been between 12% and 20%. And so that it's kind of hard to value that, but basically, let's say they grow EPS, I don't know, somewhere around 20%. Well, then I would say the stock could maybe trade for 30 times earnings, 35 times earnings. I could see that being a realistic possibility. But I like to think that like 20 should be like the bottom, right? So I would think 20 times 3.5 in 2 years. That means in 2 years, the bottom should be around $70 for this stock. And, really it should be higher than that. It should be like $90. So we take a look at this the next couple of years here, just guidance for EPS, free cash flow, and things are, there is risk, but things are looking good. The main risks are pricing pressure, reimbursement changes, and competition from other CGM makers. Dexcom's moat is strong, but in healthcare, it has to keep proving superior accuracy, ease of use, and physician trust to defend that position. If competition intensifies or adoption slows, both the growth rate and the premium valuation could compress. That's kind of the double-edged sword here. And with investing, things can move exponentially when you look at a company's valuation goes up because of earnings growth, usually, right? As long as you're not talking about a stupid stock like AMC or GameStop, typically it's because of earnings growth. You look at Micron, look at AMD, Nvidia, all those companies are experiencing huge earnings growth right now, and their stock is exploding. So, but my point is, when you get that earnings growth, then the PE is also going to rise. So it's not just about, let's say, if you double your EPS, it means that the stock price is not just going to double. It means the PE could double or almost double, and then you get a 4x or so in the stock price, right? So those things can happen. So here's kind of the bear base and bull case for the next couple of years, which, if we want to do a quick estimate of this, we could say, so the base case for 2028 is around 360 and then around $5 in 2030. So the midpoint for all this, I would say, is about $4. That seems to be $4 is kind of the midpoint between all these numbers. $4 EPS at a cheap valuation, I would consider like a bear case would be 20 times earnings. That put the stock at $80 over the next couple of years. And again, that's like a bearish case. I would say closer to, if they're growing EPS at these numbers, I think 30 times is very, doesn't mean it's guaranteed to happen, but it's very realistic. So 30 times 4 is 120. That'd be a 2x on your money over the next 2 to 3 years, let's say. I think you'd be lucky to get that in the next year. I don't know if you're going to get that. It's possible you get that in the next year, but I think 120 is realistic 2 years, 3 years from now. And if we want to look more into their moat, we could see their moat is durable, but it's narrow because they have high switching costs for continuous glucose monitoring systems, which is a positive, significant intangible assets. But while the company faces increasing pressure from competitors like Abbott and Medtronic, its core advantages allow it to maintain strong margins and a dominant market share. Once a patient and their physician integrate a specific CGM like the Dexcom G7 into their daily plan, the hassle factor. See, now this is the part where it says this about a lot of different companies and products. I don't always buy that. I think it's not that hard to switch services and products than what AI says a lot of times. So just keep, some things are stickier, but a lot of these are not as sticky as they make it sound. The mode is heavily supported by proprietary algorithms and a deep patent portfolio. And that's great, but at the same time, as important as patents are, again, a lot of companies say that, and a lot of companies have that. It doesn't always mean you have a guaranteed successful business. The lengthy and costly FDA approval process for Class 3 medical devices acts as a high entry barrier. And again, that's true, but that is not a barrier that makes it impossible for competition and for competitors to eat into your business. It just means it's slightly difficult, which is what every business out there is going through. Strong partnerships with insulin pump manufacturers for automated insulin delivery systems further lock in users, which that's great, but again, it's not a guarantee. They're projecting 2026 revenue growth of 5.1 to 5.2, which is 12%. Profitability, growth margin of 63, that's pretty strong. And growth is increasingly driven by the non-insulin. So I would like to know, what is the earnings growth going to be? Let's ask it that. Let's say, what will Dexcom's EPS growth percentage wise be like in the, let's put, be like year over year over the next 3 years? Because I'm going to look at this like, if they could grow earnings like 20% plus, okay, average annual EPS, yeah, so around 20%. So you compare that to other companies, if you're doing 20% EPS growth, I would say, again, maybe around like a 26 times earnings or so would be like that'd be my guess. If I had to pick a number for what it would trade at, I would say 26, 27, maybe a 28. You can get lucky with some stocks and maybe they trade at 40 times earnings or something, but I think then you're kind of reaching for the sky a little bit. And if we want to be realistic here, let's say, yeah, again, EPS of $4 seems to be the most. If they don't hit it in 2028, like the bullish case, then they're probably going to hit it in 2029 or 2030. So that's kind of why I'm using that number. They could do $5 EPS, in a couple of years. But let's just say four. Four times 30 or so is 120. Four times 20 is 80. So I would say between, let's see, yeah, 20 times four. Yeah. So 80, I would say $100 would be my midpoint. That'd be base case. $100 would be fair value for this stock in about 2 years, which kind of makes you want to invest in it. Again, it looks like a decent investment. You're getting it at a pretty strong low here. I mean, the stock hasn't been this price since what? 2020. We're talking over 6 years now. It's at a 6 year low. So, and we could take a look at more of these numbers, but I mean, everything is pretty solid. 2.4 billion in cash, 1.2 in debt. That's good. They're buying back shares. That's what I like to see. And let's take a look at their margins and stuff. Past 3 years, ROI 23%, very healthy. Operating margin 21%, profit margin of 17%. That's still strong. Everything is good here. And anytime I can get a stock like this, so the other way to look at it is like, okay, past 5 years, this PE has literally dropped from being in the hundreds now down to a 25. It's only a fourth, right? Meanwhile, has their growth slowed that much? I mean, see, this is weird because the past 5 years we've seen 12% growth, but then last year it grew 73% and 20% in the last 2 years, you see, so it's kind of weird. Um, so free cash flow is 60%. They have strong growth numbers. Look at especially the free cash flow. Let's factor in stock-based compensation. They have really strong, let's do this. They got really strong numbers. They got really strong numbers. So what about stock-based compensation adjusted free cash flow per share? Now that's an interesting metric. Look at that. We're looking at that's a very good. This is a very good metric, a very good way to value it. We're looking at $3. I mean, again, that's 20 times 3 is 60. We're looking at this is close. This has got to be close to the bottom. It was at 55 last year, but this has got to be close to the bottom. I really think so. Do we have any positive insider activity here? Robinhood users are selling, hedge funds are selling, insiders, lots of uninformative stuff, so it doesn't really help us. It's definitely an interesting buy. Price target's lower to $79, which is still well above the stock price today. So I don't know. I'm gonna think about this one. This is the I'm personally I'm in support of this. I would say this is a good pick. So that is my analysis for Dexcom. Let me know what you guys think down below, and I will see you in the next video.